Hi, Steve Van Metre here. Welcome to your weekly economic update where we take about 30 minutes every Friday to take a deeper dive into the economic data and to see if it makes any sense. Now, if I sound a little off today, it's because I'm sick. It feels like I'm getting over this, and I came in today to record this video and I spent time resting up in a very unproductive day to hopefully have the energy to get through this. So if I cough or if I'm breathing heavy, or if I seem like I'm in a fog, it's because I am. I actually took notes today because, as you know from our Friday night updates, I usually have a lot to say. Now, for those of you who are new, I welcome you to the video. There's something that you should understand. So why would I tell you that I'm sick and like this? Because most content producers edit. This is one cut, one take, no editing. I think it's more fun that way. It's also a bit of a challenge too. So I want to get into the headline topic. And for those of you who don't know what I'm talking about, is every week I write a piece. I put it on my website, on my Facebook page, and on my LinkedIn page. So if you can't find it, you can go to stephenvanmetre.com or go to my Facebook page and like my page or LinkedIn, and you'll see the content, which our focus today is on hedge fund managers. But I have a lot of other opinions before we get to that. And so the market is created, what I see is there's no exit. You know, we've got this melt up, and yet people don't even know what that is. They don't know what a melt up is. But the Google searches for the term melt up, a melt up stock market, are just going through the roof. So I'm going to tag that in this video, and maybe some people will tune in and actually learn what a melt up is and why this isn't one. But we're creating a market that has no exit. And what do I mean by that? Well, for those of you who've ever been down to the Los Angeles area, if you've ever been stuck on the 405 during rush hour traffic, and even if you've been stuck on the 405 outside of rush hour traffic, it's not much different. It's the same feeling of being dead stopped on a 6-lane highway, or however many lanes it has. Imagine being on the 405 during rush hour traffic in the middle of the storm, and there's one exit open on the whole freeway. One! That's what the market's going to be like. We're creating a market with no exits. And so investors want to chase this melt up. They don't want to miss out. But Steve, the stock market's going up. I got to get in. It's going to go up a bunch, and I got to make that return. You know, wise investors will tell you, and some of these people take decades of being in the industry to come to this realization. Some never do. Most never do. But those at the top will tell you, before you take a position in the market, you should have an idea of who you're going to sell it to in the future. Because if you don't know who you're going to sell it to, you're the one that's going to take the loss. And so when people start to chase a melt up, they don't realize that maybe stocks will just go up in price. That's the term melt up, means prices. It refers to a rise in prices. And maybe for a short period, it'll feel really good, right? It's like drinking a cup of coffee or soda. The caffeine is, man, it feels great until it wears off. You want to take a nap. And that's what melt-ups do. They trap people. See, most people don't know, but a melt-up in stocks comes with strong trading volume. It's a lot of demand. So if you've ever been to an auction out there, a long time ago in an old neighborhood I lived in, I was walking around and I noticed that a house was going to go up for auction. And I thought, man, I bet nobody's going to go to this. So I called my dad and said, hey, we should go down there. I've never been to a home auction. He said, yeah, it sounds like fun. Let's go check it out, and maybe we'll bid on it. Maybe it'll go cheap, because I knew the neighborhood. I lived in it. And so we went. I thought, I wouldn't be surprised if there was 100 people there. The backyard was full, the inside of the house full, and the front yard was full. And there's that moment that I realized this thing wasn't going to go cheap at all. In fact, it went over market value. So what is a melt up? It's when you have a lot of demand and people just get euphoric and they don't even care if they're overpaying. I gotta win. I'll take bid. Oh, I got outbid, go again. That's what a melt up is. And you can see it, and we'll look at the charts. Providing to remember is you see, not only do you tend to see a run up in price, which actually would be this way for you, but you see volumes, trading volume, number of shares transacted go up. And the whole notion of a melt up is when the public gets involved in the markets. Now, half of Americans virtually either own none or an insignificant amount of stocks. A melt-up would imply that those people are going to get in the market, that suddenly that they are going to get excited and start buying in, but they're not. Now, why do melt-ups need to exist? Or why do markets try to create melt-ups? So the big players can sell. Look, if you're trapped on the 405 in the middle of the storm, there's one exit, and that exit is 50 miles down the road, and you're not going to see it for a long time. How do you get off? What if there's an earthquake and you're stuck? You can't get off the road. That's the same with the markets. So why you hear all this talk about a melt-up is in part is all these people with very deep positions, not only just stock positions, but levered positions, they want to get out and they need you to buy. And so they try to incite excitement about that. So you see Wall Street, again, I'm not used to looking at notes, but I feel like I've got to stay on track here. So Wall Street keeps pushing prices higher. And they think that higher prices will get people buying. And yes, it will work for some people. But do you realize that from a dollar perspective, stocks are really expensive? So people, the average person is going to come in and say, I'm going to buy a share of Apple for $200 and some dollars, whatever it's trading, $280 a share. I don't even know what it's trading, $260, $280. You can't buy a tenth of a share of Apple. So what's the average wage? $20, $30 an hour? How many hours you got to work to buy one share? After taxes. People aren't going to do it. That's, it's like going to the car dealer and have them saying, well, if you don't think this is a good deal, we're just going to keep raising the price every 10 minutes until you buy. We'll just keep raising the price of the car until you just realize that the higher price is better. No, higher price isn't better. So the market and Wall Street and analysts and financial professionals and media are trying to use higher stock prices to get people to buy in. In some degree it works, but overall it's not. But that's the idea about it. And recently we've seen this melt up. It's not a proper term. It's not really a melt up. It's just a rise in prices. It's by hedge fund managers who have been using the repo market. So hedge funds generally own quite a few U.S. Treasury securities, bonds, bills, notes, and they can access the repo market. Now, why the Federal Reserve chooses to bail out speculators is a whole separate issue we could discuss, but we're not going to. And so what these hedge funds are doing is they're swapping for short-term loans, overnight or term loans, for dollars from the Fed, and they're pushing stock prices up to hopefully get people in the market, to make that quick gain, to get that profit, to get out, or to get them to sell their bonds, which the public pretty much already has. Everyone thinks interest rates need to go up, but that's not happening. So again, 50% of the Americans don't own stocks for the most part, and they're unaffordable. No matter, and the higher they go, it doesn't get any better. So investors are going to get trapped in this market. They haven't figured it out yet. And I'm going to show you a chart of why that is. It's going to blow your mind when you see it. I wish I created it, but it's pretty cool. Now, in the short term, we're seeing dollar liquidity, which the Federal Reserve has been providing short-term, overnight and short-term dollar loans. It seems to be going down. And everyone's like, oh, great. Oh, that dollar problem fixed. No. I don't think it's fixed at all. So, again, keep in mind, when we look at the lending data from this last week, this is going to be pretty obvious. But what creates dollars in the economy? Now, for a long time, viewers, you already know. Lending. Banks are the only place you can create dollars, and only create dollars when consumers or businesses go to the bank and borrow money. That's it. There's no one else can create money. The Federal Reserve, I know whatever you've heard, Go read the law. The Federal Reserve Act of 1937 specifically states the Federal Reserve cannot print money. Not in those exact words, but swap a few of them out, and you've got one sentence. The entire Federal Reserve Act of 1937 says the Fed can't print money. So all of a sudden, this dollar liquidity problem seems to be going away. Now, why might that be? Because the stock market's going up for one reason. You say, wait a minute, how can a rising stock market fix a dollar liquidity problem? When I tell you the answer, you're going to be like, oh, I get it. But let me tell you, so this is going to add to my view of why do you think Wall Street and hedge funds are all trying to push the market higher? Because what do you trade to buy stocks, right? Money. So let's say you've never owned a stock in your life. How would you do it? Well, you'd open up a brokerage account and deposit what? Dollars. And then you'd swap those dollars to a securities dealer who's owned by who? Yeah, the major commercial banks. Pretty cool, huh? Rising stock prices kind of alleviate in themselves a dollar liquidity problem because it gets people to trade dollars for stocks. The other thing that's of note, and we saw this on Monday, and we'll look at it again on this coming Monday, when we look at the speculative positioning of hedge funds managers in the futures market, is that they've been reducing their dollar longs. Well, when you reduce your dollar longs, what does that do? That weakens the dollar, or it attempts to, and puts dollars back in to the financial system. So essentially, hedge funds have been driving the market up and trying to create dollar liquidity. That's what we've seen. And all of a sudden, we've seen this dollar liquidity problem start to kind of disappear a little bit, but it'll come back in a big way next year because all these term loans are due. All these term loans come due in January at different intervals, but effectively the Fed pushed things back into January. Now, another thing I want to talk about that you may have, depending on how well you read financial information, you may have heard that there was going to be this big selling of Treasury bonds by large commercial banks going into the end of the year. Now, that when we look at the data, they've sold about $40 billion worth of bonds, but I don't think they've sold it the way it would normally work. And I'm going to hold that thought for a moment. And the reason this opinion came out is an analyst for Credit Suisse, who I believe was one of the architects or is either an expert on the repo market, said, hey, if you understand the G-SIB score, globally systematic important bank score, that is tallied at the end of every year, determines how much additional capital a bank has to reserve above and beyond their normal regulatory requirement. And additional capital means more Treasury bonds. Go figure. And according to his research, which is accurate, the guy does actually know what he's talking about. He said the banks would have to sell bonds and drive interest rates up. Now, the banks sold bonds and interest rates didn't go up. Now, why would that happen? So let's say you're a CEO of a major bank, Mr. or Miss CEO. And your executive team comes in one day and says, hey, CEO, we've got a problem. Our G-SIB score is going to go up. And that means we're going to have to reserve some extra capital above and beyond our normal requirements. And you as CEO are like, that's not good. Okay, well, as soon as you've done the research, what do you have to do? What do we have to do to fix that problem? Well, we're currently here on the G-SIB score chart. Now, just so you know, virtually every bank is being penalized. I'll write about this next week, but for the most part, every major bank is being penalized. So, well, we don't want to go up a level because it means a bigger penalty. If we could just stay where we're at, and the CEO, you're going like, yeah, I'm already buying boatloads of Treasury bonds just to keep our collateral where we need it to be, and I got more to buy. So your team says, here's the deal. We've looked at all the options. The easiest and quickest solution is we need to dump a massive amount of our Treasury securities by the end of the year. And you're like, what? The capital that I need to maintain my Basel III regulations and all this other stuff imparted upon me by the regulators globally and in the U.S. by the Fed. And you want me to sell my Treasury securities and they need that I've been buying all year? Yeah, that's what we want you to do. Okay, well, let me ask you this. Let's say I do sell all these Treasury securities, what's going to happen to interest rates? Oh, well, interest rates are going to go up, sir. And how is that going to impact lending growth? Where are we at with that? Oh, no, lending's not looking too hot right now. So you're telling me this big hoopla over all the spending going on over the holiday season? No, it's not as good as it looks. So I'm going to drive interest rates up to get my G-SIB score where it's at. And lending growth is going to take a hit, and we're going to drive us into recession. Yeah, that's pretty much it. Okay, you know what? I'll get back with you. So you shoo them away, and you pick up the phone. Hi, this is Jay Powell's office of the Federal Reserve. Please leave a message, and I'll call you back. Hey, Jay, this is bigwig CEO at super large bank. Yeah, remember me? Hey, I got a problem. My G-SIB score is going to go up. And my management team tells me the solution is I got to dump a bunch of Treasury securities. I'm looking at the lending data. I don't know if you've looked at that lately, but if you haven't looked at the lending data, it's pretty ugly. The reflation that everyone's been talking about is not happening. So if I'm going to dump all these Treasury securities on the market, interest is going to go up. It's going to kill the lending market. Now, you know what's going to happen if the lending market gets any worse. You do know what's going to happen, right? Because you've told everybody that you've done 3 rate cuts as a mid-cycle adjustment. And if you cut rates one more time, everybody knows a 4th rate cut means the Fed is off, and that means things are really bad. And so if I do this, you're going to have to cut rates, and you're going to look really bad. So get back to me, okay? I need an answer to this problem in a couple of weeks. About 3 days later, the Fed comes out and announces an increase in their overnight and term repo limits. And they add some term repo to the calendar. And so what happens is the banks shuttle those bonds over to the Fed for some dollars that they probably used to buy more bonds to shuttle off to the Fed. Now, when a bank shuttles bonds over to the Fed, is it a sale? Sure. But not really. Because the Fed's effectively paying market price. So it's different when they sell to the open public, right? Because we bid. I don't think I want to pay that much. No, I don't want to pay that much. No, I don't want to pay that much. Fed? Oh, yeah. What's the current price? Here you go. Here's a check. So this notion that interest rates were going to spike at year end, now there's 2 days left in the market. Obviously, it's not going to happen. Interest rates didn't spike, because the banks knew what they were doing. Pretty interesting. We'll just look at the data to see how it plays out here. This video is going to go a little longer. Apologize for that. But we didn't have a video on Wednesday, obviously. The M2 money supply was up 7.57% from a year ago and is continuing to rise. Now, people cite this as and will inaccurately cite this as a reason that the economy is growing, and it's not. I'm going to show you why. The 6-month rate of change is actually reversed and the 3-month rate of change is down, but the 12-month rate of change is up. Now, let me switch over to this here. And this is a breakdown of the M2. So we see M2 increase, but where did it really increase? Savings deposits went up. Is that bullish for the economy? When consumers save more? No, when consumers spend. How about institutional money funds? They were fairly flat. But let's take a look at institutional money funds real quick and see where interest rates are headed. So here you have institutional money funds, and you see that during expansions now, since the Fed's really over playing their hand, they stay fairly static, and then all of a sudden going into recessions they rise, and you see that here. So let's go and add 10-year Treasury yields. And I just wanted the reason I do some of the stuff live is it's really easy. I mean, you can go and play with these charts yourself. It's totally free. So now we see there's no relationship. You say, I don't see it. Okay, well, let's invert it. Let's invert the institutional money fund. And there it goes. And we'll zoom this in a little bit. And what you see is when money is flowing into institutional money funds, interest rates go down. So money's been flowing into institutional money funds because when there's more cash on the sidelines, interest rates go down. You see this little rally in yields. It's not going to stick. We've seen this before as cash is being raised. So we know that's not going to last. But there it is nonetheless. Let's go back to the charts. There we are. Okay, good. Taking a look at low. Oh, you know what? We should just have stayed right where we were at for this next slide here. So let's look at the assets and liabilities of all commercial banks. This update about 1:15 p.m. Pacific every Friday. And so here you can see securities and bank credit. They're down $35 billion. From the peak, they're down $46 billion. But no real movement in interest rates between December 4th and December 8th, the week ending. We'll go look at that. Hopefully, if I remember to do that, along with the other things I said I would remember, and I've promptly forgotten. Again, heads in a fog here. But we'll look at this, see if this hasn't had any impact on the markets. But let's look at total loans and leases were down. $14 billion, that's quite a bit. Commercial industrial lending only up $2 billion. Real estate loans down $16 billion. That's not good. Consumer loans, you think with all the consumer spending the holiday, it would not be down $2 billion. Credit cards, you would think would be up. They're down $2 billion. Where's automobile loans? Oh, no, that's not helping my stepson sell cars. They're down $1 billion. So, you look at this and you see there's not a lot of lending demand going on, and that is a problem for a dollar liquidity shortage. So there's going to be a dollar liquidity problem in January because we're not creating dollars, we're creating less dollars. So look at real estate lending growth. Whoops. It's down 3.84% from a year ago. So it was rising and took a big kind of nosedive here. The 6-month rate of change is down to 1.7%. And 3-month rate of change is quickly falling down to 0.8. Not quite the lowest it's been in the last couple months, but it's the second lowest. So that's not a really good trend. It's telling us everything that I've said. Now, whatever there is, maybe there's a lag here that I can't calculate, but higher interest rates are not creating demand. Let's look at commercial industrial lending. Now, the 12-month growth rate did slide up a little bit to 2.99%, but don't think it's going to hang out there very long. 6-month rate of change dipped a little bit to 0.16. 3-month rate of change is still flat at negative. At the current rate, the 12-month rate will go negative. And you will notice that normally when commercial industrial lending goes negative, we are already in a recession. We've never had a recession where commercial industrial lending contracted first. Now, maybe they'll paint the bars here down the road. We don't know. But here's total loans and leases and bank credit. This is representing 1/3 of all total lending. And you can see we're below kind of the weaker points of the prior two cycles. I mean, obviously coming out of recession, it's going to be weak coming out of recession. But look, you can see kind of the bottoms. We're around a 5% growth rate, and we're at 4.57%. And the 6-month rate of change has fallen to 1.69, and the 3-month rate of change is down to 0.73, and both falling. This is not a sign of strength. This is a big sign of weakness. And you can see that this doesn't fall off the cliff until later. Why is that? Because real estate lending usually keeps things afloat. It's not looking like that. Look at the baby boomers. A lot of them are not going out and buying new homes. They're not going to be moving during recession. They're going to be staying put, paying off their mortgages. How about consumer loans? Looking at credit cards, up to 4.44% from a year ago. Not a big rebound in the grand scheme of things. Big rebound in the last 2 weeks or 3 weeks, maybe perhaps holiday spending. But in the big scheme of things, not a big push from there. So looking at some other charts, we have the Baltic Dry Index, which is a shipping index. It is collapsing, suggesting that whatever rebound people expect to happen in the global economy is, at least if it is happening, perhaps products are magically being transported from one side of the world to another, because it's certainly not being shipped. And looking at global trade, it's also contracting at minus 2.1% on a year-over-year basis. When global trade contracts, usually it is a sign of a recession. And there you go. It's been contracting, remains in contraction. Corporate share buybacks have been off the charts. They're starting to slow down a little bit. And, this is, again, part of that trap that I talked about earlier. The investors think that, man, stocks are just going to keep going up and up and up. When companies stop buying their shares back, they're the ones that are putting the floor under this market. They're the ones that rebounded it off the bottom. But look what's happening here. Starting to slow down. And when this starts to go, there will be no one left to put a bid under the market because everyone that wanted to buy is bought. And you say, well, how do you know? Well, because this brilliant chart by Yardini Research shows the total outstanding shares of the S&P 500. Now, here it is in 2008. Lots of shares, quarterly and billions of shares. So about, 276 billion shares outstanding. And so you can see at the bottom of the market, then these companies issued a lot of shares. They actually bought them, some of them too. So they issued a lot of shares that kept stock prices down, and then until the market kind of absorbed it. And what did we see? The market was fairly weak even though it rebounded in 2009, still very weak in 2010. And it wasn't until they started reducing the outstanding shares. Now look, there is about 271 billion. And we're not at the low point of the market. Remember, the market didn't bomb until March of 2009, so we're about right in here. And at the rate of corporate share buybacks, all this is telling you is, one, there's not a lot of shares. Number two, everybody owns the same stuff. And then number three, when the buyer who doesn't, a price insensitive buyer or the corporates stop buying their own shares back, there's no one left. And that's how you get, boom, big bear market. But here's the bottom line. Excuse me. We looked at this chart before. My voice is trying to hang on here. And this is the aggregate Treasury future net speculative position. And I want to point out, and this may be even deeper when we see the data on Monday. Now, I don't get an update of this chart every week because they don't update it hardly ever, but maybe Zero Hedge will. But all of this speculative selling going into year end because of that report about how the banks were going to sell bonds and there was going to be a big spike in interest rates didn't come to fruition. They managed to move the needle from 1.9 to about 2.3 and maybe not even 2.3 by the end of Tuesday. So there's a lot of these people that are short bonds. When the short position gets unwound, interest rates go down. So you see 3.2 to 2.7, 3.5 to 1.9. With the same depth of positioning, almost at a record low, where do you think interest rates are going to go when this gets unwound? They're going to go way down and far lower than anyone can imagine. All right, let's go on to some other charts. We are going to go long. We're at the 30-minute mark, but again, we didn't have something on Wednesday for the Christmas holiday. So Merry Christmas, everybody. Anyway, so here, this was a nice piece posted on Zero Hedge today by Nomura. It says overall hedge funds net exposure to U.S. equities and trend following computer programs on the S&P 500 futures are, quote unquote, exploding. Look, so hedge funds are trying to create liquidity in the market by driving stock prices up, and they have taken a massive long position, even though computer models they're adding, but they're not nowhere near where they were at previous rallies. And you can see that when hedge funds get way offsides, usually the big guys come in and push them the other direction. So that's coming. And that kind of adds into the NASDAQ McClellan Summation Index, which is a great proxy of liquidity. And you can see despite stock prices pushing up, there just isn't liquidity in the market. The hedge funds are trying to create liquidity, but due to the drop in lending, we're not really seeing it. And this is a good point to talk about interest rates, because there's so many opinions about them, and like 99% of them or more are wrong. In the end of the day, investors, speculators, you can shift the market a little bit, but you can't change the direction. It has to come from lending demand. So when lending demand continues to weaken, interest rates have to go down. And since interest rates now are near their all-time low, And as you've seen in the charts, lending growth is at some of its weakest of any cycle in history and falling. All this speculative push to short the bond market has to get unwound. So there's going to be a huge, huge payday for bond owners when that thing gets unwound. That's if you own bonds, we do. That's when we're going to sell them. It's going to be so big, it's going to make the stock market rally look like a joke. And it's also going to make stocks look really, really cheap. Let's go back and look at some other charts here. Here's the 4-week moving average of continued unemployment claims. You notice that this is flatlining now. And what is this telling us? See, when continuous claims are falling, it tells you that people that are losing their job are finding a job very quickly. What this is telling us, and we can zoom in, is really since about roughly mid-2018, workers have struggled to find jobs when they've lost theirs. We also then, not this week, but last week we talked about the 4-week moving average of initial jobless claims. And you can see that this thing is starting, or has been flatlining since 2018 and starting to curve upwards. So when initial claims start to rise, it's a huge problem, because when initial claims rise, other than that anomaly there in 1990, which let's see if we can make it disappear so this chart will format a little bit better. How about there? When initial claims start to rise, it's almost uncontrollable. And what would cause that? Well, one is lending demands. It turns into lack of demand for goods and services. So here we look at consumer goods, durable orders, excluding defense and excluding non-defense aircraft and parts. In 2016, there wasn't layoffs because businesses didn't buy it. They didn't buy the downward trend was going to last, and they kept hiring people, and they kept bringing people back that they laid off. And now we're in the same position again. We've seen durable goods new orders contracting. And normally when new orders go down, businesses tend to lay people off. They don't need them. So at some point, as long as this continues, well, then unemployment claims have to start rising, shown inverted here. Now, how do you say, well, how do you know that's going to happen? Well, it's really easy, because average weekly hours of production workers are going down. See, in 2016, businesses they didn't cut their hours worked. Somehow they just had a hunch. They knew, for whatever reason, they knew things were going to be okay. So here you can see in 2016, there was no cut in hours worked. It was static. So employees still had money to spend. Now, hours worked is falling and paychecks are actually shrinking. Employees have been getting raises. Employees get raises. There's always a big deal about that. But if you look at a historic chart of wages, they're always going up even during recessions. The way employers fix that is they cut hours. So, honey, I got a raise. Great. They cut my overtime in half. Or they canceled overtime. Oh, well, that's not good. I'd rather have, the pre-wage overtime hours than this. So you see hours worked are falling, and that means unemployment claims are going to rise because employers don't need as many employees. There's a couple other ways to look at that. Now, I don't enable comments in this video for various. Oops, I just realized I'll need that back in a minute for a very specific reason, and that is because someone might say, well, you're picking the Richmond Fed because it can validate your view. Well, I'm not. I'm picking it because it's the most recent Fed survey. So the Fed does regional surveys ahead of the official ISM manufacturing survey, which is not an official government survey, but is considered the official survey. And so every month, usually around the middle of the month, these regional Fed surveys come out. And this one's from Richmond or Virginia area. And you see it further contracted. These are just a score. They're not percentages. These shipments went down. You can see volume of new orders, further contraction. Backlog of new orders, flat. So they're still contracting. Capacity utilization, or how much your factory is being utilized, contracted. Vendor lead time, doesn't really matter. Local business conditions down. They think capital expenditures are up from businesses, but it's certainly not showing up here. Finished good inventories are rising. That's not good. Raw material inventories are rising. Not good. And services expenditures are falling. So that doesn't tell you anything good's going on. But from an employment standpoint, now I'm not going to go over expectations because this is 3 to 6 months out and as rosy. 6 months out. Rosy as can be. Oh, look, shipments are up. New orders are up. Yeah, where's that opinion? This is fact today. This is hope. So let's look at employment. Number of employees. Well, they are slightly improving their employment situation. Wages are up, but that's not a surprise. Maybe the reason they're holding on to employees as available skills is weak. But look at the average work week. We're from 10, 3, and now 15. So as we look toward the next set of economic data next Friday, the non-farm payroll report, you get the impression that, one, we should not have a blockbuster non-farm payroll report. We should also can start to see unemployment claims rise because the work week is falling. And at some point, somebody in management says, hey, we can start getting rid of people from what we're paying them in benefits, and we can save some money. So there you go. And then last on the charts to look at, remember I said a while back that Apple would have to drive the stock market higher, and everyone thinks that so much is going on with Apple that, all of a sudden the people just figured out what the iPhone was for the first time in their life and are buying it. And yet even experts who are usually overly bullish about everything, earnings per share expectations for Apple, you can see their earnings are actually not that great, but people are crammed into the stock. And you wonder how things like the tech bubble blew up is because people had unrealistic expectations of what their stock was going to do. All right, so let's go on to some charts. We've got a few minutes to do that. The S&P 500, thanks to hedge funds for trying to pump the market higher going into year end, hoping to create liquidity, hoping to incite investor demand, hoping to get people to dump their bonds. Well, they're doing that, but it's not getting, there's really no dumpage of bonds going on. Let's look at this relationship of, you know what? I didn't mean to do that here. Let's remove that real quick. Now let's go look at the bond market. If the banks were dumping over $46 billion in bonds last 2 weeks, we would see a much bigger move here. So December 4th, week ending December 4th would be right in here somewhere to up in here. That's not a big move from we'll just say we'll give them 1.8 to 1.9. Do you think $46 billion worth of bonds would move the bond market more than 0.1%? I would think so. So again, my opinion here is the banks have offloaded their bonds to the Fed, which has not looked like a sale, but they're going off their balance sheet. They've used it to buy more bonds here because now after hitting resistance on 10-year treasuries, we're seeing interest rates go back down, and you're facing this monster short squeeze from all the short positioning in the futures market and in the cash market as well. Now let's go and add something we haven't looked at in a while, the jaws between the S&P and the bond market. So I'm arbitrarily picking here because they kind of line up the best. So this is the S&P 500, this is Treasury yields. So you see as Treasury yields went up, created a gap between, usually Treasury yields should run kind of in line, not exactly, but in the general direction. So you can see as stock price was rising, Treasury yields came back down, shot below, came back up to get back in line with stock prices, went down. Stock market said, no, we're still good. Treasury yields went back up to reconnect, went down. Market said, nah, we're still good. Went back up. Both went down. Market said, no, we're going to keep going up. Treasury yields went down. And these are called alligator jaws. You think of these as teeth along the way down. And this gap has to close. Either yields need to go way, way up. Not going to happen. Or stock prices need to go down. Now, how do we know yields aren't going to go up? Because you have the second largest, maybe now largest net speculative position in the history of the futures market. You have pretty much every retail investor that could sell their bonds has sold them. You have weakening, and big key is you have weakening lending data. The lending data is saying interest rates are too high. And when interest rates reverse, and they will, and make new all-time lows, and they will, it will eventually yank stock prices way down by 30% or more. I mean, it's just what's going to happen. So let's take a look at 30-year Treasury yields. Again, same thing. It kind of moved. I said, hey, where is it at? 2.2, just over 2.3%. Probably by Tuesday, my guess is going to be back down the 2.2s here. Again, came up, hit resistance, and held pretty nicely. Speaking of bonds, let's take a look at TLT. Again, if banks were selling $40 billion worth of bonds, that means they're selling again right in here, down to here. It's not much price movement, especially since we're not seeing much in volume either for that. But we're seeing, again, TLT move. Now, I moved these blue bar or purple bars out, and I left the all-time highs here in light orange, the dotted orange. So what we're seeing is here's where buyers are at down here. Here's where sellers are at, and here's where sellers are at. So we've held support. And that means bond prices should rise up, retest resistance right in here. And if they can break through this, then they got a run back at the all-time highs. I suspect we will see that sometime in January. And as we kind of cap this off, ag commodities, after being dumped after the announcement of the trade war coming to an end, are starting to bullishly move themselves back up. They've got a lot of resistance right in here. A lot of selling that happened. So we've got to break through that and move up. And what kind of surprised me today was oil and gas producing stocks, after being run up against this all bullish hope for rising crude oil inventories, didn't get that many builds, but finally today got a $5 million draw. Getting more. The market was hoping for draws, but got a lot more builds, hit resistance and found sellers here. So again, the status of the oil patch is not as great as everyone thinks. So, well, I appreciate you taking time to watch. So we've gone about 40 minutes, so we'll catch up. Like I said, now we'll be averaged out for the week in terms of getting caught up from the week before when I was off, and Wednesday for the Christmas holiday. So we'll be back Monday, take a look at the hedge fund manager position, and be really curious to see if they're deeper in Shortsville. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This video is not to be construed as a recommendation or solicitation to buy or sell security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steve Van Metre on personal capacity and opinions expressed in the video that I'm on and do not reflect the view of Atlas Financial Advisors Inc. or Steve Van Metre Financial.